Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are discussing CA Foundation economic concepts in the most quick and practical manner. So without wasting much time, let's get back to the video. So today we are covering chapter 8 money market, in which we will be covering unit 2, that is the concept of money supply. So here is the introduction for it. Money supply is a key factor influencing inflation, interest rates, and overall economic stability. Understanding money demand and supply helps central banks like the RBI, Reserve Bank of India, to regulate economic activities by adjusting the money in circulation. Key measures such as currency ratio, reserve ratio, and money multiplier helps determine how much money flow through the economy and how it affects growth. Then comes a rationale of measuring money supply. So accurately measuring the money supply is crucial for economic stability. An increase in money supply can boost demand, potentially leading to inflation, while a decrease can signal deflation. Monitoring these changes help policymakers at the RBI design monetary policies that foster sustainable growth and control price levels. Then comes sources of money supply. So the primary sources of money supply in an economy includes: first, high powered money that is created by the central bank, that includes currency in circulation and with bank reserves. Second, bank credit. So commercial banks create credit by issuing loans, expanding the money supply beyond their initial deposits. And third, public holdings, that is the cash holding by individuals and businesses that directly affect liquidity. So example, if the RBI issues rupees 100 billion in currency, commercial banks can lend out more than this amount, increasing the effective money supply through a multiplier effect. So the money is multiplying. Then comes measurement of money supply. So the RBI uses monetary aggregates to measure money supply, including M1, that is currency with the public, and plus demand deposits with bank, plus other deposit with the RBI. Then comes M2. M2 is equals to M1, that is earlier, plus saving deposits with the post office. Then M3, that is broad money. We earlier discussed about broad money. So broad money equals to M1 plus time deposit with banks. So kindly note this. Earlier it was saving deposit, here is time deposits. And lastly M4, which is nothing but M3 plus total deposits with post office, excluding national savings certificates. So here is an example. If the currency with the public is rupees 50 billions, demand deposits are 100 billions, and other deposits are 5 billions. So the sum of all these three would be 155 billions, which would be M1 in our case. Then comes determinants of money supply. So first, currency ratio, that is denoted as C. This is the proportion of currency held by the public relative to demand deposits with bank. So it reflects public preferences for cash over bank deposits. The formula would be currency ratio, or C, equals to currency with public divided by demand deposits. So what the total deposits and how much the currency is with the public. So example, if currency with public is 40 billion and demand deposits are rupees 80 billions, then C, or the currency ratio, would be 0.5. Then comes reserve ratio. So this is the fraction of deposit that commercial banks are required to keep with themselves as a reserve, either with the central bank or in the cash form. In India, the central bank is RBI. So a higher reserve ratio restricts the amount bank can lend out, thus reducing the money multiplier effect. So the less the reserve is to be kept, then the more amount could be lent, and vice versa. So reserve ratio, or R, equals to reserves divided by total deposits. Here is an example for it. So if a bank has rupees 20 billion in reserves and 200 billion in total deposits, the reserve ratio would be rupees 20 billion divided by 200 equals to 0.1 or 10%. Then third comes interest rates. So higher the interest rates generally reduces the demand for money, as people prefer to save or invest rather than just holding cash. Conversely or inversely, lower interest rate increases the demand for loans and thus money supply. Fourth comes public's cash preferences. So when people prefer holding cash instead of deposits, it affects the money multiplier since banks have fewer deposits to lend. So the concept of money multiplier. The money multiplier shows how an increase in high powered money, that is from the central bank, affects the total money supply. The multiplier depends on the currency ratio and the reserve ratio. Example, money multiplier equals to 1 by C divided by 1 plus C in bracket divided by R plus C in the denominator. So example, if the currency ratio is 0.5 as we calculated earlier and the reserve ratio is 0.1, then the money multiplier would be 1.5 divided by say interest rate is, just a minute, yes, the money multiplier is 1.5 divided by 0.6, that is 2.5. This means that for every rupees 1 of high powered money, the total money supply will expand by 2.5 rupees, that is 2.5 times. Then comes money multiplier approach to money supply. So the money multiplier approach highlights how high powered money combines with the commercial bank lending expands the money supply. So the central bank's role, by injecting high powered money, the central bank increases the reserve. Second, bank lending. Banks lend out based on reserves and the reserve ratio, further increasing money supply. And third, public preferences. So the currency ratio shows how much cash the public holds relative to bank deposits, affecting the extent of multiplication. Then comes monetary policy and money supply. So monetary policy actions directly impact money supply through tools like OMO first, that is open market operations. So the RBI buys or sell government securities. So when the RBI buys securities, it injects money into the banking system, increasing money supply. Selling securities withdraws money and reducing supply. Example, if the RBI purchases rupees 100 billions in government securities, the increase in reserves allow bank to increase their lending, multiplying the total money supply. Then comes second one, effect of government expenditure on money supply. So government spending increases reserves within the banking system, promoting money supply growth. When the government spends on infrastructure, payment flows to contractor who will deposit this money in the bank, which they will use for further lending. Then comes credit multiplier. So the credit multiplier shows the extent to which bank can lend loans based on their reserves. So it depends on the reserve ratio and measures how much money credit bank can create from initial deposits. So the formula could be credit multiplier equals to 1 divided by reserve ratio. So if the reserve ratio requirement is 10%, the credit multiplier would be 1 by 10, that is 10. 1 by 0.1, that is 10. So 10 billion increase in reserve can result in 100 billions in total loans creating by the banking system. So it is 10 times. Then comes MG exercise. So in this video, the activity we are having is visit any 2-3 banks website and get the details about their reserve ratio and calculate the money multiplier based on the data available and make a comparison table and analyze it. So here is the conclusion. In the end, understanding the money demand and money supply helps policymaker stabilize the economy by managing inflation, interest rate and growth. So proper measurement and management of money supply are vital for promoting sustainable economic growth and maintaining stability. So that's it from the video. Thank you. Keep learning, keep growing and keep rocking. Bye bye.